If you run your own business with others as a shareholding director, a partner, or a member of a limited liability partnership, an LLP, or on your own as a sole practitioner, it's safe to say that your preoccupation with making your business successful may mean that you pay a little less attention to tax planning. It's understandable. However, as we approach the end of another tax year, it can pay to spend just a little time with your financial advisor, giving thought to what tax savings may be possible and how to achieve them. Regardless of the type of business you run and the structure through which you run it, you should give consideration, like everybody else, to opportunities to minimise tax on income, minimise tax on capital gains by using your capital gains tax exemption, use the opportunities to invest in tax-efficient investments such as ISAs and pensions, and use your inheritance tax exemptions. And especially so where the opportunities to save tax use an exemption or make a tax-efficient investment that cannot be carried forward, that is, they're available for this year on a use it or lose it basis. I'd also like to take this opportunity to remind you that while considering tax year end planning, why not take the opportunity to plan a tax-efficient next tax year to avoid the year-end rush, so to speak. When it comes to income tax planning, if you run your business as a sole practitioner, a partner, or a member of an LLP, you'll be taxed on all of your share of the business profits, whether you draw them or not. However, if you are a shareholding director, then you may have an opportunity to make some meaningful tax savings through your income distribution strategy. Basically, whether you draw the funds you need by way of dividend or salary. Now, in making that decision, consider these facts. Dividends are not subject to national insurance. The dividend allowance, allowing tax-free dividends, is £2,000 this tax year and falls to £1,000 next year. The threshold above which additional rate tax is payable in 2023-24 falls by nearly £25,000 to £125,140. As long as your spouse or partner is also a shareholder, dividends can be paid to them too. Especially attractive if they pay lower rates of tax. So what might you consider? Well as all of the tax year end planning that we should all consider every year, and with a special focus on the opportunities to make tax-efficient pension contributions with money not needed for the business or for your everyday spending, there's the additional possibility, given that you have control over the income, to pay income out in a way that can minimise income tax. As there are a number of factors to take into account in deciding on income distribution strategy for shareholding directors, especially whether to take income as dividend or salary, and whether, and if so, how much and in what form you can pay income to a spouse or partner, then you should absolutely discuss the opportunities with your financial advisor. And like all possible tax and financial planning strategies, you'll probably run a cost-benefit analysis before taking any action. Is the saving you can generate worth the effort? It often will be, but sometimes you might decide it isn't. Again, your advisor can help you decide what's right for you.